closed your eyes and didn't look at any statement, turned all the media off April 1.
April 1, yeah.
And then closed your eyes and didn't pay attention to what happened, and you opened up your statement now, you're up. You need to set up your portfolio to fit your personality, risk tolerance, so to speak, and live with it.
50% of your money in all equities, and 50% in bonds and other things that are out of the equity market, and just leave the 50% alone than trying to put 85% in and then freak out and then miss the 10, 15, 20 days because you're getting in and out.
Right.
You would be better with half that you never touch than 80% that you manipulate.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lovaglio, here as always with the founders of Security Financial Management and Frank Lovaglio and Dave Allen. Gentlemen, what's cracking today, boys?
We're just excited to be on the show.
Summer's here. Everybody's got some trips. We got some of our partners who went to Europe this month, which is fun.
Yes, you're going to Europe tomorrow, Dave, huh?
Yes, I'm going to a wedding in Switzerland.
That's awesome, dude. I love Switzerland.
You know what's crazy about that? Think about when I remember when Dave, we kind of grew up together. When we were younger, the weddings were like in downtown Orlando. If you lived in Orlando, or they'd be in Melbourne, Florida. Now, like, hey, where are you going? Were you going over to Winter Park for the wedding? No, we're going to Switzerland.
Yeah, we're going to Switzerland.
We just said Caroline has to go to a wedding in I think in Spain. And then I heard someone had to go over to Australia. So it's like, you know,
Colombia.
I don't know, you guys, when I was like 26, I had about $16.14.
I don't think I had that.
Going to Australia, you know how long a flight to Australia is for a wedding?
I don't. First off, whatever it costs, I don't want to fly that far.
Yeah.
That's one of the most important
Crazy,
things.
isn't it?
Oh,
It's crazy. Anyway, we'll get caught up in this, but it's crazy stuff.
Let's jump into some finance today, guys. We've had a lot of questions about market volatility. Obviously, this year has been a lot of ups, a lot of downs, which leads us to the question of the day. Today's question comes from Kent from Atlanta. Kent, what you got for us?
Hey guys, I pulled out of the market during the election and now I regret it. How do you help clients stay calm and avoid making emotional moves during volatile markets?
Thank you, Kent. Gentlemen, take this over for me, please.
market volatility, Frank.
Yeah, I'll start it because I always like to be the start guy.
Of course you do.
For all the years of seminars we did.
You always
all
started.
over the state, I always started.
And you always said all my stuff, too.
Yeah, I tried to
By the
steal.
time I'd get up there, I'd be like, well,
That's what he said.
what Frank said.
That's why it's good to go first.
That's
You
so
get
funny.
all the great points, and then leave some of the tethered crumbs for you.
You know what I found out was the best way to do a seminar or a workshop with Frank is don't tell him what you're going to say.
Yeah, that's right. I'll steal it.
That's how it is with like best man speeches too.
Yeah.
I was like, I gotta go first. I don't want Austin to take my story. It's like,
No.
I always like to speak first too, because first of all, no matter how much you speak, and we tend to, all three of us, but Dave and I being 40-year veterans now, golly, that makes us old.
Ouch.
We speak all the time. So I'm really not nervous, but if you're being honest, you're never, it's just like going into a basketball game in the old basketball days. No matter how good you're playing or how weak the team is, if you don't have jitters, you're not normal.
Oh,
right?
no.
So if you're going to have jitters, it's like get your jitters over with, give your speech first.
It's still gonna
and then
hang
you
over
can
your head,
sit
yeah,
down
yeah.
and relax.
Yeah,
It's
yeah,
like
yeah.
if they say you're number 5 to speak, I'm like, what?
yeah,
Frankie,
not listening to any of the other
if that
speeches.
makes you feel good, that's good.
It makes me feel good. It does make me feel good. But to get to the question,
Yes.
volatility. I mean, we've had tons of it, right? I mean, here it is.
Shit, the last 4 or 5
June.
years.
Yeah, just and really, you think about this since January 1, how much crazy volatility we had. I was reading some stuff last night in preparation for this podcast. Then the April CBOI, which is a volatility index,
What do they call it?
or
VIX?
CBOI. No, there's VIX is another
Okay,
one.
okay.
This is CBOE, a volatility index, was at 60. Just to kind of give you a comparison, 20 is normal, so 60 is 3x of normal. The last time it got jumped to 60 or above was the 2008-2009 major financial meltdown of the world global financial crisis. So that's what people were feeling in early April, and it's logical why. In 2 days it went down over 10%. So you mind your own business. Just to make up easy math, you had $1 million in the S&P, and you went on vacation just a weekend, 2 days. You come back and it's 900.
Didn't you have somebody, one of your buddies call you, one of your good long-term
Oh
clients?
yeah. during the whole thing. Well, even better than that, I got a call on the way down, but I was actually at a family wedding. A good friend's son was getting married over in the Keys, and I was minding my own business, and market went down 5% the day before I got there. Another 5% as I'm pulling up at 4 o'clock. And everyone's
sucks.
like, and, over the years, your friends become your clients.
You're keeping a straight face with a vein in your forehead.
I mean, I'm last thing I want to do. And they're like, hey, Frank, we're glad you're here. We want to. What's going on? Like, what? Like, I don't completely know.
They wanted to know what you should do.
Yeah.
Right?
What do I do?
What'd you tell them?
I said that's time to have a scotch. That's what I told them.
Pour you a thick drink is what we're going to do here.
I don't always drink beer, but when I do, I prefer those Zackies.
It's interesting, when we have a client come in, we prep them a lot. And also, I do a constant reminder of, okay, when you were invested in a new client, you've invested in 2008, right? 2008, 9, do you remember it? Yep. Do you remember the way you felt during that period of time?
Yeah.
Yep. Did you? How'd you react? Did you call your financial advisor? Did you just not care? Did you freak out? Did you have bad dreams? What happened? I was okay. Okay. Well, did you think you were conservative? Did you think you were aggressive? Or did you think you would react the way you did? Yeah, I didn't know I was going to act the way. Or they tell you what they're thinking and say, that's how you should invest.
Gotta live it.
Yeah, because putting yourself in constant fear of the markets is the worst thing you could ever do in a portfolio.
Absolutely. And you look at what happened in April, right? So the CBOE is at 60, comparable again to 2008, 2009 financial crisis. Then all of a sudden, then we look at May. What happened in May? Oh, it was only the best market since 1990. So, right? So then you look at that. So 30 was the best market over 30 years. The
best month.
The best month.
No one's talked about
30
that.
years. No one talked about that.
I didn't even hear about
so
that.
So you got 2 days with -10. You need to have scotch.
You're hearing about all that.
You hear all that, but then all of a sudden, a couple weeks later, you go, oh, it's June now, right? Hey, how did May do? Oh, it's the best month in 30 years.
Yeah.
That's the let me finish this
Timing
thought.
the markets.
Timing, yeah, because I want you to get into kind of why you stay in, but just a couple quick facts or I'll forget. Best May since 1990. The S&P up over 6% for the month. NASDAQ up 10% for the month.
Wow.
So again, if you had $1 million
Yeah.
in tech, which a lot of people love technology, I believe in it. Well, you made $100,000 in technology in 30 days. Right? Now you could lose 30. Lose it in 30 days.
If you closed your eyes and didn't look at any statement, turned all the media off on April 1.
April 1, yeah.
And then closed your eyes and didn't pay attention to what happened, and you opened up your statement now, you're up.
You're actually up.
So that's probably the best thing to do is know you're invested appropriately and not worry about it. Here's a couple little facts.
Those are great.
I always like to toss a few little facts.
Good.
This is a kind of a long period of time, but it's real. If on 12/31 of 1979 you invested $10,000. I mean, that was a lot more than it is today. I don't know, probably 50, 60, 70,000 now. But in general, 10 grand in end of 79, and then looked at it on March 31 of this year.
How many years is that approximately? 70,
45.
Okay, 45.
45 years.
So you got almost 4.5 decades.
So this is missing the best days on the market. So if you stayed fully invested and didn't worry about trying to buy and sell or time the market, your 10,000 is worth 1.635 million. Okay. Now, in that 40-something years, if you missed the best 5 days, you were out and you missed the best 5 days because you're likely to miss the best 5 days.
Usually, worst bad days are
followed by
great days. So you got scared and got out 5 times. You're like, I'm scared. You got out. What happened?
Okay, so here's what happens in that same time frame. It's 1,013,000. So it was $500,000. 1.6 million versus 10. Now let's get even more dramatic.
Wow.
Over 40 years, if you miss the best 10 days, that doesn't seem like much over.
No.
Yeah.
I mean,
4 days a year, you got scared.
That's a week and a half, right?
Yeah.
Okay, 4 days a week, you got scared. It's worth 730. Okay,
Big difference.
so 1.6 to 730. You're less than half.
So that's over $800,000.
Now let's just get more dramatic. You missed the best 30 days over that period of time. It's 262,000, and you missed the best 50 days. it's 114,000.
But it's a great
So
story.
45 years, bro.
Yeah,
45 years.
So that's
So
not
4 or
many
5
days.
times you get
yeah,
scared.
yeah.
That first 2 are most real, 5 or 10.
Yeah.
Because how many times do we know with our
Mark goes
40-year
down, you
career,
pull your money.
There's the people call it, hey, I'm scared. What we need to stay invested. No, I just got to get out.
Yeah, to add to this,
There you go.
this is the S&P 500.
Mm-hmm.
It's the stats. It's the S&P 500. It's not our portfolio. That's just the straight S&P.
S&P, yeah, the index.
So the bottom line is you need to set up your portfolio to fit your personality, risk tolerance, so to speak, and live with it. And also invest money that you can leave alone and stay there and work for
agree.
you, as opposed to putting money into it that, whew, I sure hope in a year it is because I need that for a house.
It's almost better. We've talked about this again over, when you
Scotch.
Yeah, Scott. And also, 80 years between the two of us. You learn a little bit, hopefully, after 80 years of cumulative experience. But one of the big things that and it really hit me almost maybe 10 or 15 years ago was it's better to put less in the equity markets and just let it run. So if you say on a scale of 1 to 10, 10 being you're an aggressive investor and 1 being put under my mattress in cash because I'm terrified of the world, let's just say you're about a 7, which a lot of people fall in that 6 to 8. They want to be growth, but not, micro cap stocks at 10. And it's better to put, in my opinion, instead of saying, I really want to be super aggressive, when you're really not, because you don't really know your risk tolerance till the market goes down.
Yeah.
You feel big and bold in an equity bull market, but as soon as it goes down, you're like, why am I in it? And then you get scared. It'd be better to put, just because it's easy, we do analysis on each person, but for purposes of the show, 50% of your money in equities, and 50% in bonds and other things that are out of the equity market, and just leave the 50% alone than trying to put 85% in and then freak out and then miss the 10, 15, 20 days because you're getting in and out.
Right.
You would be better with half that you never touch than 80% that you manipulate.
Kind of seeing this all. Absolutely.
But Robin, to add to that, and I'm not to interrupt you,
Yeah,
but
good.
add to that, then you got other people that have super high tolerance that can live with it and don't worry about it as long as they have enough cash flow and other money set aside.
Absolutely. I'm talking about the person that
We got
gets
to
concerned.
match the person.
Yeah, it's all.
I'm sorry, Rob. I
No,
interrupted.
you're good. I was saying just from like a bird's eye view, kind of seeing it from not the advisor perspective. I feel like your clients have gone from A to Z with that strategy, meaning like in 08 and 09, I was interning here, phone was not stopping, right?
Yeah, it was
and as your clients have kind of gone through it with you guys, I've seen just from my side of things that they trust it now. They're a lot more comfortable in.
Think about ever since 08 or 09, right? 8, 9, then you have the COVID. I mean, COVID feels like a long time ago, but what did it go down 30% in a couple of months, right? COVID was just, that wasn't that long.
Yeah.
It feels like long, but COVID was like
18
20.
wasn't good either.
18 was, but COVID was real significant.
No, you're very
8,
significant.
9 was real significant.
Yeah.
22, not that long ago, was down 20%,
yeah.
right?
So they've been through it with you guys.
And
which
what's interesting, Rob, back in 08, 09, more than half the phone calls wasn't about the market. It was about people losing their jobs. What am I going to do? Trying to sell their house that they bought way high, because the real estate market
6
was
and 7.
6 and 7. You bought at a high, and then in 08, 09, your house was down about 40% in value. So it was about that. So it was. That's why they called it the financial crisis. It wasn't just the stock market. It was the
Everything.
whole
Credit
Yeah.
collapse.
And as a financial advisor, Frank and I became more mental health counselors than we were financial advisors.
for ourselves, too.
I still do that today. But that's the one thing about a good financial advisor is they keep you with a level head. They talk to you about the past. How did you react in the past? I mean, go sit with a mental health counselor. Guess what they'll do is they're going to reach back to your childhood. Hey, tell me about when your dad used to spank you with the belt. No, I'm kidding. I never got spanked by my dad.
I think this needs to be more spanking.
I think I need a good spanking right now.
Oh man.
Maybe not.
I love it.
Well, I hope that helps, Kent. If you want to talk to one of our founders or any of our senior advisors, I'm going to leave a link in the description right here. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.